Welcome to our regular 6-minute strategy with me, Guy Monson, and our chief economist, Subitha Subramaniam. The world's leading central banks face an awkward combination of slowing growth, stubborn inflation, and mounting political pressure. Wage growth, elevated energy prices, and tariffs all continue to sustain price pressures, now compounded, of course, by the energy disruption arising from the Iran war. Against this backdrop, Kevin Warsh appears set to succeed Jerome Powell as chairman of the US Federal Reserve on May 15th. Mr. Warsh is regarded as financially sophisticated, market-friendly, and historically hawkish on inflation. Yet he will assume office under intense political pressure from Donald Trump, who has made little secret of his preference for lower American interest rates. Britain illustrates the same dilemma in miniature. Markets at once expected a steady sequence of Bank of England rate cuts are now pricing the possibility of rate rises. Investors increasingly fear that the challenge to Keir Starmer's leadership will open the door to a less disciplined fiscal regime. In the slides that follow, Subitha and I will examine the challenges facing Mr. Warsh and the implications for markets in the months ahead. So welcome, Subitha. Lovely to have you back on 6-Minute Strategy.
Thank you, Guy.
Let's begin on the left here with the oil price shock. We all know the numbers. Brent crude up 70% year to date, that dark blue line. That's triggering a big surge in global supply chain pressures and lifting prices across a whole lot of associated goods and transportation, etc. That's almost triggered an interest rate shock, and markets reacted dramatically. Tell us what the futures curves say.
So the futures curves are predicting now that we will have no rate cuts in the US, and actually rates will be held constant till the end of the year. For the ECB, the futures are predicting 2 rate hikes, and in the Bank of England, instead of rate cuts, we are now going to have 1 to 2 rate hikes. So the real point here is that, this inflation shock coming through from the Middle East is translating to an interest rate tightening across the world.
I see. And at this point, this new leader appears for the Federal Reserve, Kevin Warsh. Harvard, Stanford, then Morgan Stanley, joined the White House as economic advisor to President George Bush, and then, of course, served on the Federal Reserve Board for 2006 to 2011. What are the challenges he's going to face?
So there's a lot of discussion that Kevin Warsh has made a Faustian pact with President Trump, and he's out there to cut interest rates. I think that misses a broader point about him, that he has to navigate a world that's going to be dramatically different from Jerome Powell. He has 3 really big challenges. The structural side of the US economy has fundamentally changed. There is little to no immigration, yes, and artificial intelligence is really leading a turbocharged spending splurge on capital investment.
And does this mean that he has to also look at the operating model, the role of QE, for example?
Yes, so I think there's now broadening consensus across many economists that the central bank should really have a much smaller balance sheet, yes, and it should use interest rates more actively. We are not at zero interest rates, so there's no need for a central bank to have such large assets on its balance sheet.
And thirdly, of course, we're now in a world where we've got a supply shock rather than the demand problems we had previously. How does that change his outlook?
So I think the conventional wisdom is if you have a single supply shock, you look through it, as long as inflation expectations are anchored. Now we're in a world where we're getting repeated supply shocks from climate, from geopolitics. We have no idea where the next one will come, but we can say pretty surely that there will be another one. And that's hard for central banks because that unanchors inflation expectations.
If you look at his first challenge, you have a particular message there for much weaker labour markets. Talk us through what's happening there.
So under President Biden, immigration really surged, and we had 3 million new entrants into the US economy. So this led to a situation in the labor market where job growth was running roughly around 320,000 every month. President Trump has had much draconian policies for immigration, and so this has really meant that immigration has fallen and the job growth in the economy has now fallen to just 31,000 jobs every month since he has taken office.
And of course, in the rest of the economy, you're getting a huge capex drive out of the tech story and AI.
Yes, so if you think about the supply side, at the first instance, you're having fewer workers, which is inflationary. At the same time, you're having this huge spending in capex, which is actually straining a lot of the supply, yes, side of the economy. So that is also putting an inflationary impulse.
Against this backdrop, Warsh has been very vocal about reducing the Fed balance sheet. You can see it's come down a long way already. What are the risks there?
So when the Fed reduced the balance sheet in 2018, it started to get to levels where the financial markets started to feel a lot of strain. Warsh has said that he would like the balance sheet to be somewhere around 15 to 18% of GDP. So those are the dotted lines. And we're approaching levels where the financial system may not be able to cope with that much reduced liquidity from the Federal Reserve. So they cannot actually execute this without deregulating the banking system more aggressively. So he will need to work much more closely with Scott Bessent at the Treasury, and together they need to chart a very difficult path to reducing the Federal Reserve.
But it means bank deregulation, which is broadly good for bank equity prices. Just finally, goods inflation rising, services still stubbornly strong. Now that's the core CPI number there we saw earlier this week, the headline CPI number rising to 3.8%. What's your feeling on the inflation pressures he's going to face?
So I think he's come out very aggressively and said, well, artificial intelligence is going to be displacing a lot of workers, it's going to increase productivity, and it's going to be disinflationary. But the reality is that that is probably some way down the line. Right now, we're facing a lot more supply constraints than we are productivity increases. So I suspect he's going to have much more challenges on the inflation side.
Against this all, of course, what we have is an economy that's barreling along despite the oil shocks, particularly in terms of nominal GDP growth. And this is fantastic to profits. We've looked at this chart I've just updated on previous 6 minutes, and you can see we're expecting global earnings growth from companies to rise an extraordinary 29% in the year ahead, led, of course, by the hyperscalers and the Mag 7. But also revisions just seem to keep rising. How does Warsh react to this, and what's the message from high nominal growth?
So, I mean, high nominal growth suggests that the economy is actually running hot. It's got a mixture of high productivity as well as higher inflation. So that's really great for corporate profits. He needs to also think about the wealth effect that's coming through as equity markets keep marching ahead. So I think at this point, I think he will struggle to really convince the rest of the FOMC that he needs to cut interest rates. He is, a very practical person, and I think he'll just wait to sort of chart his course.
So we're on hold.
Yes.
Well, thank you very much, Subitha. We might need you back again on the next episode because we've got to talk about the dramas of Keir Starmer in the UK bond market. But in the meanwhile, thank you for a wonderful profile of the new leader of the Federal Reserve. Thank you.
Thank you, Guy.